In case of a bear market attack, break glass and listen to this.
It's Brian Preston, the money guy.
Okay, maybe don't break glass. That sounds a little unsafe. But if a bear market does attack, listen to this.
It was giving a visual cue reference, Bo.
I just don't want all our listeners going out there breaking a bunch of glass.
All right. I think we're in agreement on that. So let's talk about this, though, because, guys, especially this is going to be a special episode for several reasons. We are sending this out as a value add to our clients. So, if everybody who's a podcast client, everybody who's a Bound Wealth client is going to actually get to see this episode before it goes live. And part of that is because we know that markets freaking out just does crazy things to everybody. They emotionally start wanting to head for the exits.
Well, and, if you think about it, we really haven't seen a lot of volatility or a market downturn in quite a while.
Yeah.
And so now that it's kind of entered in the fourth quarter of 2018, we're kind of remembering, oh, yeah, this is what it feels like when the market just doesn't go up all the time.
So we don't want you making some type of short-term decision that derails your long-term financial plan.
That's right.
So our goal is knowledge is true power. So if we can help you kind of inoculate yourselves, or have that bear repellent, you like that? Tied it into the title. I think it really will serve you well. So let's kind of walk through these. I want to talk about what you can do and also some stats and facts that will let you know what your neighbors are doing that you've got to avoid falling into these bear traps. So here, let's jump into these. Success starts with a plan. Bo, I did some research on this.
Yeah, I think we love this all the time because it's one of Stephen Covey's quotes, right? He says, you always have to kind of begin with the end in mind. And so if you want to be successful, you have to kind of think about the end. Well, you can't do that unless you have a plan in place.
Well, Charles Schwab, what's interesting is this is not the first time I've covered this topic. Mm-hmm. We know that there's what's called a market cycle, is that every decades, you're going to have some downturns. It's just part of the cleansing and growth. Just like you prune your bushes and fruit trees and everything else, the market kind of naturally does it too. Right. I think it's interesting. A lot of times when I've talked about the need for having an investment plan or a financial plan that ties in, I've used Fidelity Investments. I thought it was interesting. The most recent research was actually coming from Charles Schwab. So not only are these guys fighting over who has the lowest investments, they're also fighting over who provides
the
best
content
research
out there. Yeah.
So here's the research I found. Charles Schwab did a research study that's really got some disappointing news about Americans and your ability to plan or taking the initiative to plan. And this is what they found, that 3 in 5 Americans live paycheck to paycheck, and that only 1 in 4 have a written financial plan.
Wow.
That's big. But those who do have a written plan exhibit positive investing and saving behavior. And that goes deeper. Listen to this. When we look at the top 10 percentile of overall performers in our modern wealth index, that's the research study, there's a consistent theme that they're diligent planners. 3 in 4 say they have a written financial plan. And then it goes on, it says, planning is critical to achieving any goal. It's like establishing an exercise regimen to get in shape. We need to take the same approach to keep our finances in good health and on track.
So I think what's really interesting, just kind of think of the statistics. If you just want to put yourself in the camp of folks who are set up to be successful, just having a plan in place naturally moves you in that direction.
So a plan is going to help you and insulate you from a lot of those emotional concerns. But let's go even deeper on the emotional, because this is the advice I always give people: avoid the herd mentality. Right. It drives me crazy, but it's just the nature of the industry and the way money works, because they're totally playing off of our emotions. I did this on purpose, and you'll see why I'm going here, Bo. This is a headline from January 15th of 2016.
Okay. U.S.
stocks post the worst 10-day start to a year in history.
Oh, no.
In history, stocks posted the worst 10-day start. I mean, do you remember this? We lived this, and our clients, we're doing this on purpose for you guys. We're kind of taking a walk through history, guys. Does anybody remember the rest of the story? Because here's what happened from January 4th of 2016 and all the way to January. It was around January 20th or so. The market lost 11%.
That's a pretty substantial drop inside of just a few weeks in 1 month.
So you hear that and you're like, okay, the market's down 11%. There's no historical time that's done that. It probably was a disaster for the rest of the year, right?
Sure.
Because there's also this anecdotal thing that however January goes, the rest of the year follows.
That's right.
There's people that believe this stuff. That's what's crazy. So I got another little side, and all of our clients are like, oh gosh, he's pulling it out. Because we use this one on our quarterly commentary a pretty good bit. This is talking about intra-year volatility, meaning that every year, because we know this from markets get reported at the close of December 31st, and everybody looks back from January 1st to December 31st, and they tell us if it's a positive year.
That's right.
And that's what we forever remember that year about.
And maybe you've heard some statistics that the market makes, like 10 or 11% on average. Most of the times, it's not just making a steady, nice little 10% every single year, year in and year out. That's not the way it works.
Well, we've talked about, because we've done it on other shows, is that it's close to 78. I think it's around 78%. If you just looked at the stock market on a year-over-year basis, about 78% of the time it's positive on a one-year basis. But that's only part of the story,
right.
and this is why we show this chart. On average, every year, despite the fact that it's up usually 78% of the time, every year there's an intra-year drop of 13.8% of 29 of the last 38 years.
And I just think about if I was an investor sitting there and someone said, hey, how would you feel about losing 13% in a year? You'd be like, oh, that sounds awful. No way. Don't sign me up for that. But what if someone said, how would you feel about losing 13% in a year where you made 8% over the entire year?
Well, take this case study of what I just talked about. January of 2016, all the headlines are saying this is the worst in history. Market's down 11%. And by the way, there's our confirmation on my chart. It's down 11%. There's the dot down there at negative 11. But wait a minute. The year actually ended up being positive by 10%.
Yep.
So I'm telling you all this is because a lot of you guys are watching this stuff now, and you're closing out 2018. We're in 2019, but this is going to carry on for years afterwards. And I want you to know the advice doesn't change. I'm going to get into more specifics later. And it's so funny how I give the same advice over and over again. I just update the data, and the data doesn't change
That's
a ton either. This is behavioral. And if you want proof that it's behavioral, look at this. I love this. And I did a little shock and awe. So you see this, Bo?
I see it.
You see how it has no web things or anything else on it? You know what I did?
I have no idea what you did.
So Carl Richards
Behavior
does
Gap?
these little, behaviorgap.com does these little cartoon type things. I bought this.
Oh, nice.
He sells them on his website.
Okay.
So we actually own a digital version of this that we could blow up if I wanted to fill up the wall with this so that people would get the idea.
Thank you, Carl.
Well, I thought you'd be mad at me because you're such a tightwad, but I wanted to do Carl right in the fact that he came up with this, and I love it because we always show the cycle of market emotions. And, and just real quick to repeat the cycle of market emotions, people, when you're making money, they think they're brilliant, they get excited, and that's
There's
the
some thrill
cocktail
to
party. Yeah, it totally feels like, man, everybody should be making money, and that's when that greed is kicking in. But then we go through the market cycle, and the market starts going down. People start freaking out. They get, they get desperation. They get fear, panic. Oh my God, what have I done? I'm never investing again. Is what they think when they get to the bottom of it, and that's usually when they sell. But I always like to point out that up here where things are rocking and rolling and great, that's the maximum point of financial risk. At the bottom of it is the maximum financial opportunity. But what is the reality of the emotional situation of the average investor is they do what Carl talks about, is that here's the greed and here's when the buy indicator kicks in.
That's right.
So let's buy this thing. It's good.
All your friends are making money, so you got to get in.
Starts getting a little bit of a hiccup, some fear. Let's get out of this thing now.
I've lost everything. I got to get out.
And then we repeat the process until we're broke.
Yep.
That is the herd mentality, if I could summarize it. And I get it. Look, the news media is sensational. Their headlines, if they're designed for anything, it's to create an emotional reaction. So you keep your eyeballs on, whether it's print media or whether it's the TV.
Yep.
They need your eyeballs there so they can sell ads and they can keep making money. So I get why they're doing it. Unfortunately, you guys are reacting to it. You're kind of, instead of being creating a financial plan, an investment allocation that reflects your long-term plans, your risk profile, what age you actually want to reach some of these financial goals, you're reacting to these things, and that's usually the worst time to make these type of adjustments. And you put a Warrenism in there. What do you mean by these?
I think anytime the market freaks out, one of the things we can always do is we can think about, well, what does one of the greatest investors of all time say about this thing that we're happening? And I think that Warren Buffett says it fantastic. He says, you always want to make sure that you are fearful when others are greedy and greedy when others are fearful. So if you want to set yourself up for success and avoid the herd mentality, you got to kind of take a measure of the temperature around you. And is this a time when people are greedy and I should be fearful? Or is this a time when people are fearful and maybe I should capitalize on that opportunity?
That's easier said than done.
Oh, yeah, for sure.
Because emotionally it feels hard to want to take advantage of a really good downturn in the market.
Right.
So, but that is, I love what Warren Buffett always puts out there. But let's actually put some analytics to this thing. So we've talked about be careful of the herd mentality, but let's talk about missing the best days. Because a lot of people think, well, the emotional compensation comes from if I just get out, it will stop the pain.
That's right.
And the cautionary tale I will tell you, whenever people tell me they just want to get out to stop the pain, you're not really stopping the pain, because here's what's going to happen. I can predict it, is that it will temporarily give you some relief, but the problem is when recoveries start to happen, you've exasperated and extended the pain, because now you're like, oh my, I missed it. I missed it. Because remember, markets usually, economies are growing, markets are growing, and missing the best days can be costly. So let's kind of talk about this. There's always temptation to want to get out. And I love that Fidelity Investments keeps updating this research study that they've been doing really since 1980. It's January of 1980. They invested $10,000, and they like to show how much that money grew. By the way, if you're curious, $10,000 invested in 1980 would grow to be all the way up to 700. I'm missing my number. Was it $708,000?
Yeah, I think it was right around that.
So I loved how the fact that it was that $10,000 investment in 1980 all the way through June 30th, June 29th, I believe to be exact, of 2018. That's the most recent data. It grew tremendously.
That's right.
But here's the rest of the story. If you missed the best 10 days, if you missed the best, why can't I say that? You missed the best 5 days, 10 days, 30 days, and 50 days, you gutted your performance.
So over that entire period, if all you did is you just accidentally were out of the market for 5 days, for 10 days, for 30 days, or for 50 days, it dramatically affected whether you got that big multiplier over the whole long term.
Over 37 and a half years. I actually calculated it out because there's about 9 trading holidays each year. So if you looked at how many trading days are available, that's approximately 9,400 trading days in the financial markets.
Okay.
So let's hear what these numbers did. If you missed the best 5 days, it actually drove your performance down 35%.
Wow.
If you missed the biggest 10 days, your performance dropped by 52%.
So just 10 days out of 9,400, is that right?
Yes.
Cost you half of your return over that entire life cycle.
If you missed 30 of those days, of the biggest days, you lost 81%.
So roughly 1 month over a 37.5-year period could have cost you 80% of your upside.
And I even put, I mean, it was so interesting because these aren't even, when you say rounding errors, I mean, 30 days is like 0.3, 50 days is like 0.5 of 1%. Right. I mean, we're not even talking about 1%. So you'd have to get it right. That's just unbelievable odds. Yep. And if you missed 50 days, it's 91% of your return got gutted.
Unbelievable.
So a lot of you, there's going to be some trolls, some knuckleheads out there going, well, wait a minute. That's one-sided. If you could miss the best days, it probably cuts the exact opposite way, too. If you miss the worst days, it would also be awesome. Yeah. And that is a true statement. However, we all know markets are up much more than they're down, meaning that the progression year over year of the financial markets, and that makes sense because the economies are growing, you got innovation, you got all kind of positive things. I think it would be much harder to pick the days because you are getting into a timing situation of trying to avoid those worst days. Whereas the point of why I'm sharing this data is, and it's that old quote, it's not timing the market, it's time in the market.
exactly
Because you
right.
know what? It's easy to do our strategy. If you just stay focused, stay invested that 37 and a half years, the market lets the assets do the work for you. So you're not working with your back, your hands, your back. The money is working for you. And here's another thing. It's an echo of something we've talked about on a lot of shows, Bo. I tell everybody, I get so excited that 20-year-olds have the opportunity to go invest in something like the S&P 500 when they're 20 years old. And if you put $1,000 in, by the time you retire at 65, so that's approximately 45 years, it has a chance to probably be worth about $88,000.
Yeah.
So it's 88 times over growth. Look at how much this, I thought this was an awesome thing that 37 and a half year period, the money had grown 71 times over.
Yeah, so it's
So
powerful.
right on track to that same 88 that I was talking about. It's nice that it's not only a theory of a calculation that I've provided our listeners and our clients, it's also what history shows by just staying invested in the financial markets.
I think what you have to remind yourself, and we've talked about this before, Brian, is that volatility is uncomfortable and it doesn't feel great when the markets are going down and when they're misbehaving. But we use this analogy all the time. You and your wife cook a lot at the house, right?
Sure.
Sometimes investing is like when you reach out and you touch a hot pan, right? And you get a blister on your finger, and it's like, oh my gosh, that blister really, really hurts. Selling at the bottom or getting out would be like just cutting off your finger.
Yeah.
You're coming up with a very permanent solution for a very temporary problem. So you have to think about it in those terms. Volatility is sort of this temporary thing. How does that fit into the long-term context of what I'm trying to accomplish? And I think, again, going back to Warren Buffett, he has a fantastic Buffettism. He says, doing reasonably well investing in stocks is very, very easy. Buy a low-cost investment, preferably over time, dollar cost average, so that you end up owning good businesses at a reasonable average price. That's all you have to do. He didn't say buy at a super low price, buy the best company, invest in the best thing. He said just do it and do it consistently over time and be in the market, and it's not that hard to be successful.
And dollar cost averaging is an opportunity. It cuts volatility. That's why I love, when we have some financial mutants that are in our client base, that whenever markets get beat up, instead of looking at the glass half empty, they look at it as glass half full and actually try to find more money because they know that this is a great time to potentially pick up even more
exactly right.
great valuations. That leads to my next point that ties in. Recoveries happen fast. So if you're one of these people that's trying to time it, here's a cautionary tale I'll tell you is that it's also a great moment in history. October 3rd of 2002. Great days in history. Do you know why that is so important? And you kind of do because we talked about
I'm
it.
thinking about like important days in history and
I tore my office apart looking for this. Here's what I want our listeners and our clients to know. If you watch any talk, say cable news, what happens at the commercial breaks? There's always, they have a newsletter that's being sold where they say, the person that called the downturn of 2002 or the dot-com bubble has got a new prediction for you. And they always say, hey, they called it, and they give them great weight.
Right.
You realize, Bo, if we were selling newsletters, we're sitting on a gold mine. Because I tell you, if I had music that we didn't have to pay royalties on, we'd put this with it. October 3rd of 2002 was the very first published column Brian Preston ever wrote.
No, there's a picture of a guy. There's a young man in that picture.
That is a young man.
That's a young man in that picture.
This young man was trying to look as old as possible. But October 3rd of 2002, wrote my first column ever for a local newspaper in the metro Atlanta. And this was the title, What You Should Know in an Uncertain Market. Man, see how these trends don't change?
That's right.
And this is what I want you to know, is that I told people if you'll just stay the course, this type of behavior happens very quickly. And here's the cool thing. This prediction, this column was published 3 to 4 trading days from the dead bottom of the dot-com bubble. How cool is that?
Pretty impressive.
That is like being on record, an actual printed record of making a prediction that worked out. But here's the cool thing. I'm not a timer, so I don't even believe in it. I'm just telling you if you don't fall prey to because I didn't really know that we were 4 days from that.
Sure.
I'm just giving you great advice. And here's the great advice that I was sharing when I wrote this piece. And this is the quote from the column. It says, on average, markets rise by 9.8% 1 month after they reach the bottom of a bear market.
So say that again. The market in the first month of recovery can make 10%.
These are the historical norms when I wrote this column back in 2002 is 9.8% in 1 month. So you're almost picking up a full year of performance because most people are really excited.
Yeah.
If you can make 10% a year,
It's a great year.
You're doing cartwheels. So, but markets when they hit bottoms, you typically historically make 9.8% 1 month. If you fast forward and go, what does it make in 12 months, a full year? The number jumps up to be 26.2%.
I mean, that's the normal return for like a couple years, right? If you sat that out, you missed a big chunk of growth opportunity.
What I love about looking back on fun things, because that's a lot of time has passed since 2002, we can now go back and actually say, well, okay, Brian wrote this 4 days before we hit the dead bottom of the .com, so we don't know really what the recovery, even though I made that prediction,
right.
I didn't know what the recovery actually was going to be. We can go now look at it. We can then also, now we've had the greatest recession since the Great Depression in 2008 and 9. We can go back and look at those numbers because we can see the data. So let's see what happened when you actually look at those historical facts. Check this out. This was pretty exciting for me. The actual recovery from the .com, so from October 9th of 2002 to November 8th of 2002, the S&P 500 returned 15.2%.
So well above the 9.8%.
It was better than the 9.8%. And then the 12-month recovery was 33.7%, well above the 26.2 historical average. So that was awesome. But check this out. And then I'm going to give you a phenomenon that happens, and you can pay attention to this, so it will help you cope. The deeper the fall, the better the recovery is what I want you to keep in mind. Because the Great Recession, we had the lowest point on March 9th. So from March 9th, 2009 to April 9th of 2009, that 1 month return was 26.6% in 1 month.
That's unbelievable.
But it was the Great Recession. So, realize this thing got crushed. So it makes sense that it made in 1 month. That's not a year, by the way. Even though it made a full year's return, multiple years returns. That's 1 month. A full year, 12 months, from March 9th of 2009, the return was 68.57%.
The deeper the drawdown, the bigger the recovery.
It's kind of like the pluck effect. The tighter you pull a rubber band down, the more it's going to launch. And that's exactly what happened. So if you're going through heavy pain from a market downturn, I want you to give yourself some coping skills to know that if it's really steep on the down, the rise is going to be pretty quick, so that you need to be very careful about trying to time it.
Because you got to be there in order to get that. For those folks who hit that capitulation point in the fourth quarter of 2008 or first quarter of 2009 and said, you know what, I'm out, I can't take it, I can't handle it, they missed out on that.
That's exactly
68% rate of return on the upside.
Now, I'm not the first person to think about the steepness.
Sure.
This is actually Newton's third law of motion. I'm going to go ahead and just bridge it to investments, though, is that in quote, for every action, there's an equal and opposite reaction. It works for investing. That's why you typically hear about market recoveries or what are called V-shaped recoveries. You don't hit the bottom and then ride there. It usually hits the bottom and then off to the races it goes. It's a V-shaped recovery. You had a Warrenism for this one, too.
Yeah, so what I think is so fortunate is, fortunately, we don't have a lot of 2002s or a lot of 2008s. I think you said, it happens once or twice a decade when you kind of have that downturn. And maybe we're in that right now, maybe we're not. Nobody knows, and that's kind of the beauty and the scary thing about investing is you don't know when that happens. But Warren did say this: opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. So he says when there's opportunities that abound, you want to really make sure you capitalize and take advantage of those opportunities. What I think is really interesting is he doesn't mention the umbrella. He doesn't say run inside, get out of the rain. He says when there's opportunity there, you got to be present, you got to be willing to take advantage of that.
I want to, because I had one other carrot type prop that I was going to show, and this is from Brian Westbury and those guys at First Trust.
Oh, yeah.
I love when
stuff.
they update this stuff. It gives the visual of, you can see this is all going all the way back to 1928. Might even be before 1926 actually.
Yep.
What I like is the visual. It shows bull markets versus bear markets, and I want you to pay attention to the visual. Notice the blue is the bulls, and then this orange, red, my printer is off a little bit, but it's kind of an orange-red. is the Bears. There's a lot more blue on
yeah.
this page than there is the orange-red.
Icebergs versus ice cubes.
And listen to this. The average bull market period lasted 9.1 years with an average cumulative total return of 480%. Wow. The average bear market has lasted 1.4 years with an average cumulative loss of 41%. Guys, if you can put up with a little pain, there's a lot of upside to being an investor. And it makes sense from a common sense perspective. If we're always growing, innovating. It's not a zero-sum game. If you go look at companies, I'll even pick on a company that's not doing as great right now, like General Electric.
Yeah.
General Electric has always been like this crown jewel, blue chip. If you go look at General Electric in 1960 and look at General Electric in 2018, even though it is on hard times on the way it is perceived by the investment marketplace, the earnings of General Electric it just swallows the earnings of 1960, and it's the same. That's why economies continue to grow. Right. It's not this gambling casino that people think they are, but that doesn't stop people from trying to create systems, and that leads to my next point. You're not as smart as you think you are.
Oh, isn't that a tough one to kind of sometimes come to terms with, to really wrestle with and be okay with?
Well, and fortunately, I feel like the more education you get, the more you can inoculate yourself from getting this hubris or pride or whatever, because there is a research that comes out every year. It's Dalbar's quantitative analysis of investor behavior. They come out with this every year. And what's funny to me is the data hasn't really changed that much. It's kind of the rounding errors change one way or the other, depending upon how people behave. But it just shows you that the typical investor is lousy at doing it. And this is why I think we do a good job of being not only a person that does the analytics for clients, but also tries to be coach to keep them from letting behavioral stuff derail the long-term goals. Because the average investor underperforms the market by about 37.6%.
That's over the last 20 years, right?
Yeah, well, and a lot of people, because when I first read that stat, if you look at the average equity investor to the S&P 500, they're leaving 37.6% of the long-term 20-year average return on the table. And I was like, well, wait a minute, diversified portfolio. It makes sense that they're getting less because they're taking less risk. No, this stat is actually of equity holdings. Just looking at an average investor's equity holdings versus the S&P 500, they're leaving 37.6% on the table. I can tell you an easy way to avoid that. Buy index funds. We love buying index funds. They're low cost, they're very tax efficient, and guess what? They match the market. So it fixes those things. But here's the crux of what I think the real problem is. The average holding period for equity funds is 3.8 years.
That's not great.
Bo, give them a refresher on why 3.8 years on an equity holding before you sell it stinks.
Yeah, so, remember, we talk about the financial markets kind of move in these cycles, right? Well, what we know is that you really shouldn't have any money at risk or involved in the markets if you can't step away from it for 5 years. Because typically, if you look at the analytics, 5 years is when it takes for a full cycle to happen and a recovery to happen to make up for it. So even if the next dollar you put to play went in at the very worst time, odds are if you give it 5 years, you've given yourself enough time to write it down and then write it back up, so you're back to being positive. If you're churning and moving it over every 3.8 years, there's a really good chance that you're selling at some of those bad times, that 1 to 2 times a decade where you haven't given your portfolio enough time to do what it's naturally going to do. So if your turnover rate or if your time horizon is less than 60 months, you don't need to be somebody who's buying and selling.
Yeah, I don't want you buying risk assets unless you can be a long-term investor. Right. That's the key issue. So if you can't leave that money invested for 5 to 7 years, you need to probably have more liquidity in your portfolio. That's just a known thing. I want to talk about a good visual of how to think about investing too over the long term. Okay. I've used this. Many of you have heard me say it. I've used it in client meetings too. Is the visual I always try to explain to people about the way financial markets and investing with a diversified portfolio works is you, the investor, are a person on a journey with a yo-yo, meaning that as you are on this expedition up the mountain, you're throwing the yo-yo up and down. And yes, that yo-yo is going up and down. And that's the volatility of day-to-day trades. But the good news is over the long term, if you look at the full adventure of this expedition, you are going to higher and higher ground,
right.
even with the yo-yo going up and down. And that's a visual I've used for years, and I think it does a lot of good for people who have a hard time differentiating between that short-term mindset and the pain that comes from it to what are my long-term goals and how do I get there? And how do I we've heard every one of the stats I've shared, it is great to be an investor. But there's an unfortunate thing about being an investor in the fact that you're going to have some short-term pain.
That's right.
You don't get the good without the bad of volatility. It's just a fact of investing.
And we'll talk about a few ways to cope with that. But again, kind of playing with that same example, if you're someone who finds that yo-yo going up and down is something you really struggle with and we have this volatility, you might be someone who needs to shorten your yo-yo string. Now, you can't not have a yo-yo string at all, or then you're just holding a yo-yo, you're not actually moving. But if you can shorten the string, the undulations are different. And that's where you talk about risk tolerance and risk capacity and diversification. That's how you shorten that yo-yo string.
I got one better. If you have trouble with the yo-yo, how about hire a professional yo-yo?
Oh, there you go.
I mean, I'm the type of guy that can walk the dog, go around the world. That's the type of yo-yoer you need to walk up the mountain. Seriously. I mean, if you are having trouble, if you feel overwhelmed, if you feel emotionally like you can't handle this, because it's hard to yo-yo sometimes. I mean, we'll take the load off. I mean, that's the thing. I'm serious because there's a lot of people. I think they do such a good job. My parents were these people, is that they were great at saving. The behavior, the deferred gratification was there.
Which is the hard part.
But the component of actually investing and letting the money work, part of it was they didn't know any better.
Yeah.
And then the other part, I think there probably was some fear.
Sure.
And that's why I will tell you, if you're one of those people, you're struggling, you know you're good at making money, you're good at being disciplined and saving the money, this is a great way for you to have somebody to help you with the journey. So let's kind of go ahead and move into the next transitional phase of what are the healthy ways to deal with uncertainty.
Well, hold on. I got to put my warnism in there.
Put
I
your
got to. I have
warnism
to.
in there.
All right. I want you to do me a favor, though. Remember that bull bear market one. Hold that one up again because that was a good one, right?
I'm like
All right.
Vanna White over here.
So if this were a game, right, and you wanted to bet, do I want to be in the blue side or the red side? You would probably say you want to be in the blue side. I mean, it takes up the vast majority of the page. This is what Warren said. He says, you would be making a terrible mistake if you stayed out of a game you think is going to be very good over time because you thought you could pick a better time to enter. You got to be in the game, not be picking when you're going to start getting in the game.
I like that you added all these Warren Buffett comments.
I do what I can.
That was Bo's flavor. So let's talk about these healthy ways. Number one was focus on your long-term goals.
That's right.
It's definitely one of those things this is an echo of something we've already said in the show. If you can't keep your hands off of the money for 5 to 7 years, or at least have a plan that has short-term money like liquid money, as well as mid-term money and then long-term money, you're doing it wrong.
That's right.
So focus on having long-term goals and then a plan that reflects those long-term goals.
That's exactly right.
Number two, build a broadly diversified portfolio.
This is shortening your yo-yo string. If you're someone who can't be out there and just deal with the wild undulations, or maybe you can deal with the wild undulations, but you've done the hard work over an entire lifetime of saving that your portfolio is large enough you don't need to be taking those wild undulations, diversification is the way that you shorten that yo-yo string. And that's one of the things we help our clients with is making sure that the risk in their portfolio matches their financial circumstance as well as their risk tolerance.
And it is number three, re-examine your risk level.
That's
because if you've won the game, why are you taking on so much additional risk? And, because I think a mistake that the financial media does not do a good job of talking about is they always focus on, because it's on that 10-question questionnaire that you see at 401k meetings or with the commission guys, is that what's your risk tolerance? They'll ask you, hey, market goes down, how are you reacting? You could be the biggest cowboy that's willing to ride that bucking bull for as long as it will hang on, but there's a problem. As you get older, you might not have what's called risk capacity or the time to let the portfolio recover. Because if it takes you 6 to 8 years because you took too much risk for the market to get back to level and grow, it's going to devastate you when you retire and need to live off these assets. So understand the different levels of risk. You have risk tolerance and risk capacity. And then we put on here, educate yourself. Now, you're taking a great first step watching this video. Money Guy family, Abound Wealth family members, you guys know we're going to we have those hearts of educators that we want you to know as much data, and that's why we load you up, because we feel like The more educated you are as a consumer, the more you go, I get it. And
right.
you're not going to fall prey to somebody trying to keep your eyeballs on something because they're scaring the heebie-jeebies out of you. And then, Bo, you put this last one on here, which I liked, was learn to turn those lemons into lemonade. What do you mean by that?
Yeah, so if you're a client of Abound Wealth, listen to this right now. This is what we're already doing. You're already seeing this happen in your accounts. You've seen it happening. You're continuing to see it happen. If you're just a money guy listener out there and you're do-it-yourself or doing it on your own, these are some things to think about. But one of the things that happens when we see volatility, especially like volatility at the end of the year, is there's a great opportunity to go out there and harvest losses that you can use to either offset gains from earlier in this year or even potentially use in the future to offset gains that may come. Sometimes the markets provide you with a fantastic tax planning opportunity. The other thing that you can do is you can reassess where your portfolio is, and I don't know, if there are areas in your portfolio that have been beaten up pretty badly, say international or small cap or large cap or whatever it may be on the equity side, maybe this is a great time to do a rebalance to position some assets there. You want to sell the things that have done well and buy the things that have not done well. That's the Warren Buffettism of buy low, sell high. Volatility is that thing that provides the mechanism for you to be able to do those things. So if you can see this volatility and see these downturns as opportunities, not just times to be really scared and really nervous, it'll help reframe to where you actually do turn into that mental financial mutant that recognizes, oh, this is just part of the process, and I'm going to do the things during this part of the process I'm supposed to be doing.
Now, there are a few of you out there. This is a good gut check opportunity, too. You heard Bo say, use this as an opportunity to reevaluate. Maybe you got, because we've had such a good run with the financial markets, you've gotten a little out over your skis on how much risk you're taking in the portfolio. The reality is that this is somewhat similar to 2016, the fact that it looks bad in the short term, meaning that we've had a tough quarter so far, or really tough 2 months.
Couple months,
but it's I think in the grand scheme of a year to date, it's not the worst time in the world historically, so it's a great reevaluation moment. Right. If you find that you are panicking, you're losing sleep over this, reach out. Let us know how we can help, because that is a key indicator that something's just not right in your design. Right. Something's not right in your do-it-yourself portfolio. So use this as an opportunity to create a plan, because we've already heard the research from Charles Schwab, the research in prior years from Fidelity Investments is those who plan are the successful ones. So what are you doing? Don't be a dreamer, be a planner, and then consider taking the relationship to the next level. For our clients, if people, we want you, if you are having any uncertainty, reach out to us. But if you're not a client, but you're sitting there and you feel all alone on an island, we do this thing. We call it the abundance cycle. We love on you. We give you this tons of free advice with the thought that, you're going to at some point want somebody to look over your shoulder. And those moments where you're feeling alone and you're feeling concerned, you're worried that your big enterprise, you are the CEO of a big financial enterprise because you're disciplined and you've done it. Let us be the one that helps you out and figures out the next plan of action. I'm your host, Brian Preston, Mr. Bo Hansen, moneyguy.com. And by the way, a lot of you guys, because we are sending this out to our clients, you're like, I like this YouTube thing because we're embedding this link. Subscribe. We always love getting subscribers on our YouTube channel, as well as checking us out on our podcast and all the other social media ways we connect with our clients. I'm your host, Brian, Mr. Bo. We'll talk to you soon.